Hello, everyone. Welcome to another Self-Directed 101. We do these weekly, live every Tuesday at 12 Eastern, 12 noon Eastern. Before we get started, we do have a brief disclosure to go through. Everything provided in today's presentation is strictly for educational purposes. We are a neutral third-party administrator of self-directed IRAs. We are not attorneys, CPAs, financial advisors, or anything like that. So if you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We're more than happy to be a part of that dialogue with your team of professionals to make sure everything is structured and the process is quick and seamless. We also do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We always believe that you should do your own due diligence, whether you're investing your personal funds or retirement funds. And if you have any questions, just feel free to reach out to us at any time. So, a few things we'll go over today in the Self-Directed 101 is understanding self-directed IRAs, different types of accounts that can be self-directed, what does self-directed actually mean, different types of investments you can make, investments you cannot make. We'll also go over how the process works, and at the end, we'll talk about a few tax considerations and resources you can look into. So understanding self-directed IRAs and 401ks. What is a self-directed IRA? What does self-directed mean? You can go to Schwab or Fidelity or Vanguard, and they may tell you you have a self-directed IRA with them. But when they say that, they mean you can direct your investments to anything off of this list. With a true self-directed IRA like the ones at Camaplan, there is no list. You find the investment that is right for you, and we help facilitate the transaction. Self-directed is just an adjective. All of our accounts are self-directed at Camaplan, but in essence, they're the same accounts that you would open anywhere else. Traditional, Roth, SEP, Simples, HSAs, ESAs, which we'll go over in a second. All the same rules apply, contributions, distributions. Self-directed just means that you're investing into an alternative investment and not publicly traded assets, so to say. Here's a quote from one of our clients: investing in what you know, understand, and can control versus using hope as your strategy. A lot of times clients come to us for diversification to be able to use their investment strategies for alternative investments that they currently invest into personally, and use that to utilize their retirement funds in that process and benefit from that those strategies. So what types of accounts can be self-directed? A few seconds ago, I mentioned that self-directed is just an adjective. In essence, you're opening these accounts. You have your traditional IRA. Well, you have two buckets to start off with. You have your tax deferred and you have your tax-free or post-tax accounts. So you have your tax deferred bucket. In that, you have your traditional IRA. You see, we have spousal listed there, but spousal can also be a Roth IRA. That's just an IRA where if you have a working spouse and a non-working spouse, the working spouse can contribute to the non-working spouse's account on their behalf, but that can be a traditional or a Roth. But to go on, you have your traditional IRA, your SEP IRA, and simple IRAs. The SEP and simple IRAs are employer-linked plans, employer-linked IRAs, and then you have your employer plans like the 401ks with a defined benefit plan and the defined contribution plans. Those are some tax deferred accounts. And then in the other bucket, you have the Roth IRA, the health savings account, which is the only account of its type, which has tax deferred contributions. And if for a qualified medical expense, the distributions are also tax free. You also have your educational savings account, also referred to as Coverdell. And then you have your Roth portions of your 401k. 401ks can be tax deferred, and depending on the plan, they can also have Roth portions. So again, the two buckets are tax deferred and tax free. We like to phrase it: would you rather pay the taxes on the seed or the crop? With a tax deferred IRA, you're paying on the crop because you're not paying taxes on the contribution, but years down the line, when you take the money out, that crop or that distribution is being taxed. With the tax-free account, you're paying taxes on the seed or the contribution, whereas years down the line, when you're eligible to take a distribution, those earnings and initial contributions are tax-free. The differences between a 401k and an IRA, the main differences is with a 401k, you can take personal loans from $50,000 or 50% of the account balance, whichever of those amounts is less. The contribution limits tend to be higher for the 401ks, and then UDFI or unrelated debt finance income rules don't apply to the solo 401k where they do to the IRA. We'll go over UBTI and UDFI towards the end of the presentation as well. Here's a chart of different avenues of earnings and what do you get to keep if you make $100,000 through one of those avenues of earnings. So you make $100,000 with your W-2 salary, 40% in this case, you're paying 40% in taxes to Uncle Sam to help them keep the lights on because you're paying federal, state, local, Social Security, Medicare, and your employer's paying taxes as well. So 40% or $40,000 ends up going away to taxes. And then you have your passive income, your rent, royalties, interests, dividends, and capital gains. If you earn $100,000 through one of those through that avenue, in this bracket, you're only paying $25,000 in taxes, which is still a lot, or 25% in taxes. Then you have your tax deferred and your tax free accounts at the end. Both earn $100,000 and they stay $100,000 while it's in the account. But there is an asterisk next to the tax deferred account because you will be paying taxes on that at distribution. Whereas the $100,000 in the tax free account is $100,000 cash in your pocket. We have another visual that helps here. This is a chart over 40 years at a 10% rate of return at a 30% tax bracket. What do you get to keep if you invest through your taxable income? In the blue, your tax deferred account in the light green, or your tax-free account or Roth IRAs in the dark green. So over 40 years, you can see that the blue is paying taxes all throughout. While it's important to note at the end of that timeline, the tax deferred and tax-free accounts both earned $2.2 million. However, the tax deferred account had to pay $700,000 in taxes at distribution. They both earned $2.2 million, but the Roth IRA is the only one walking away with $2.2 million after the distribution, whereas the W-2 salary or your taxable income only earns $700,000. So that's a nice visual that I like to show people. I'm a little partial to the Roths for good reason. Now, the big question is, what types of investments can I make through my self-directed IRA? So in general, there's real estate, there's notes and mortgages or private lending, private placements, precious metals, and then there are other investments. People invest into tax liens. I've seen people buy bees and sell the honey. I've seen people invest into trees and sell the fruit. As long as you're following the prohibited transaction guidelines, you can make these investments happen for you. We'll go over the main investments in a little bit more detail in the coming slides. So first off, we'll talk about real estate. So real estate, it can be single family, it can be multifamily, it can be undeveloped plots of land, it can be commercial property, it can be rentals, it can be buy and holds, whatever works for you. But the way it works is, and this you'll see this throughout all of the investments, the purchaser for that property is the IRA, which is a separate entity from you. It's not you personally buying the property with your IRA funds. It's the IRA itself as a separate entity, similar to a trust, that's going out and buying the property. So when you get an agreement of sale, the purchaser is going to be Camaplan FBO, which stands for benefit of your name IRA. And then you'll initial next to that signature line, and then Camaplan will sign on behalf of the IRA as third-party administrator. So again, it can be single family apartments, commercial properties, undeveloped land. That's how it works if you wanted to buy real estate. Then you have your private lending, where, again, rather than you being the lender personally with your retirement funds, the IRA itself as a trust is the lender on that note. So on the promissory note, Camaplan FBO, which stands for benefit of your name IRA or Roth IRA or whatever type of account you have with us, is a lender on that note. It can be secured via mortgage. It can be unsecured. Some people do unsecured notes for whatever reason. You can be convertible notes where the loan turns into shares of an asset based off some terms later down the line. You can buy notes on the secondary market. You don't have to originate the note. So there are a lot of options with private lending out of the self-directed IRA, as you see here. The important thing to note is the lender on the note is the IRA, and the lender's address is our address, Camaplan's address here in Ambler, Pennsylvania. Private placements probably, I would say, is our most common asset, because it's, I would say, the most passive. This is where you invest into shares of privately traded companies that don't have an IPO, that haven't gone public yet. They have an agreement, a subscription agreement, and a private placement memorandum, where before these companies go public, the only way you can invest in them is either lending them money or through one of these private placements. So there are a number of different types of companies you can invest in with these private placements. But again, they'll have a subscription agreement where the subscriber on that subscription agreement is the IRA as a trust, not the account holder personally. Another investment a lot of our clients use for diversification purposes are precious metals. So the IRS allows you to invest into certain precious metals listed here, like gold, silver, palladium, platinum, as well as other metals like the precious metals composite is a type of metal that is a composition or combination of gold, silver, palladium, and platinum that you can purchase as well. And then certain coins like silver eagles, some people invest into, can also be purchased with the IRA. However, we'll go over prohibited transactions in a second. Because the IRA owns these metals, not you personally, you can't have physical receipt of these metals. So meaning you can't personally have them in your house. You can hold on to them. So they have to be stored in a secure depository, which is handled by us. You'll send the money. You'll transfer the money into the account at Camaplan. Then you'll send in the invoice from the precious metals dealer you're working with, as well as our precious metals directive. And we'll send the money to the dealer, and the dealer will send the metals to a depository in the name of your IRA. Now, what can't you invest into with self-directed IRA is what a lot of people come across, and I have to talk to people a lot of the time about. So prohibited in transactions. The IRS put into place prohibited transaction guidelines just to make sure that people aren't using the IRAs in shady terms to grow their retirement accounts faster than they want, so to say. So the main things that are prohibited are collectibles and life insurance or hard to value assets. So any works of art, somebody can throw paint on a canvas and say it's worth $2 million, where somebody off the street might say it's worth $2. So it's a hard to value asset. They don't want you investing in it from your IRA. So works of art, rugs or antiques, metals or gems, but you'll see that at the bottom there's the exception for the gold, silver, palladium, platinum, and certain coins that we mentioned in the previous slide. Stamps, another type of collectibles, and then alcoholic beverages like wine you can't hold in your IRA. You can invest into companies that are dealing with these types of investments through a private placement, but your IRA directly cannot invest into these investments themselves. To talk about prohibited transactions a little bit further, another thing prohibited by the IRS when you're investing with your IRA is any personal use and any self-dealing. So the IRA has to be making an investment, an arm's length transaction, strictly for investment purposes. So you as the account holder and any disqualified persons are prohibited from receiving a direct benefit to the IRA and its investments, as well as providing direct benefit to the IRA and its investments. So if your IRA owned a property, you can't live in that property, even if the IRA owned it at 1%, and another entity, including yourself, owned the other 99% of the property. You still can't live in the property at all. You can't work on the property at all because you're not paying any taxes on the income earned by the IRA. The IRS wants your IRA to go out and pay somebody who's going to charge a competitive price that will have to pay taxes on the income they earn from doing that work. So again, no sweat equity, no personal use, no self-dealing. We have a graph on disqualified persons here. So when I said any disqualified person, including yourself as the account holder, is prohibited from providing these benefits or receiving these benefits from the IRA and its investments, these are the people I'm talking about. So it's you as the account holder and anybody of lineal ascent or descent of you, including parents, grandparents, children, grandchildren, and any entity that these people own 50% or more of or have managed and control of. So for example, if your IRA owned a property, you can't hire your father's uh, paint company to go out there and paint the property. It has to be a non-disqualified person. So anybody in blue and any entity that they own 50% or more of or are managing control of are prohibited, whereas anybody in green is okay. So I said lineal, ascent, and descent are prohibited. However, lateral relationships like aunts, uncles, cousins, siblings, nieces, nephews, they're okay. So again, it has to be an arm's length transaction strictly for investment purposes. And these rules are put into place by the IRS. And this is for any IRA. This is not just self-directed IRAs. This is any IRA. However, you come across it a little bit more often when you're working with these alternative investments, rather than publicly traded assets. So what does the process look like? So we went over the different types of investments, and each one of those investments have different types of supporting paperwork that needs to be submitted for these investments. However, the general process is the same. So the first step is you open up an account at Camaplan, similar to the account that you plan on funding it from. So if you have a traditional IRA at Vanguard or Fidelity or Schwab, you'd want a traditional IRA at Camaplan. You would then, if it were coming from an IRA, you would submit a transfer request where we request the funds on your behalf to fund the account. If it's coming from an employer plan like a 401k, that would actually be a rollover. And rollovers we cannot initiate like we can initiate transfers. So you'd submit a rollover form for us for record keeping. That's an internal form. And then you would have to initiate that rollover directly with your plan administrator. On average, we tell people to expect about 2 weeks for the account to get funded. We process everything on our end within 2 business days of receiving paperwork in good order. And the application itself takes about 15 minutes. Once the account's been funded, you'll receive an email notification from Camaplan, and that's when you can start working on your investment. So you choose the investment that is right for you, and then you submit the necessary paperwork for that investment. So for real estate example, you'll get an agreement of sale, and you'll send that in to us with our asset purchase directive. If it's a promissory note, you'll send the asset purchase directive. There's another promissory note acknowledgement, which is a Camaplan form, and then you'll send in the promissory note itself. If it's secured, you'll have mortgage paperwork or something along the lines of that. You'll send that paperwork into us. We'll sign on behalf of the IRA as third-party administrator. We'll process that within 2 business days and send the funds to the investment provider, and then you'll deposit the profits. If you're renting out a piece of real estate, then your tenants will send in rental checks made payable to the IRA directly to Camaplan. If you have a note, your borrower will send interest and principal payments directly to the IRA at Camaplan. If you have a private placement, you'll receive dividend payments from the company you're invested in. And then you rinse and repeat. So you can take those earnings and reinvest them, or you can transfer them back out to do your publicly traded assets. So what does Camaplan do? Why do you need this? So the IRS actually requires that you have a third party facilitate the transactions for your IRA, and that's same for self-directed IRAs, and that's where we come into place. We're a neutral third party. We don't sell any investments. We don't make any endorsements. We're not CPAs, financial advisors, or attorneys, so we don't give any advice. And you wouldn't want any advice from us because we're none of those things. We just facilitate the transactions. We tell you what documents we need in order to process the transaction. And then we keep record of all the transactions and report to the IRS at the end of every year. We're a part of your core team of professionals. So like I said, we're not attorneys, CPAs, or financial advisors. But if you do have those attorneys, CPAs, or financial advisors, and you want to get their opinion, if you want us to be involved in that conversation, more than happy to get on a phone call or an email thread to make sure everything's structured based off of their advice. So some frequently asked questions that we get: what's the timeline to open and fund a self-directed IRA? We went over that in the process briefly, but again, it's 15 minutes to open up an account online. Then on average, we tell people to expect about 2 weeks for the account to get funded. We process everything on our end within 2 business days of receiving paperwork in good order. However, when you're funding an account, there are other factors that go into the funding on the other side, where it's the other custodian's processing timeline, if they're sending a check or a wire. If it's a check, we'll have to wait for the postal service to get it to us. A wire is obviously much quicker. If the status of the account, if the funds need to be liquidated, and then after the liquidation, the funds would need to settle. So there are a number of different factors that go into that, but on average, it's about 2 weeks. It could be much quicker. It could take a little bit longer, depending on those factors. How do you fund an IRA account, and how long does that take? We just went over that. But the main ways of funding the accounts are via transfer or rollover. Transfer is IRA to IRA, where we can actually request funds on your behalf from your other IRA custodian. And then a rollover is if you're coming in from an employer plan like a 401k and you're moving that into an IRA, where we can't request those transactions on your behalf like we can with the transfers. So you actually have to initiate that with your plan administrator after the account's been set up at CamoPlan. Another way people can fund the account is via contributions, like you contribute to other IRAs. All the same rules apply with contributions and distributions, depending on the account that you have, that apply to the accounts outside of CamoPlan. So we went over the process and how to invest, but again, the way it works is after the account's been opened and funded, you'll submit the necessary supporting paperwork for the investment that you plan to make. Every different type of investment category has different investment paperwork. So real estate, you'll send in an asset purchase directive, which is a CamoPlan form, and then the agreement of sale, which is obviously an outside form where the purchaser on that agreement of sale is the IRA, not you personally. You'll initial next to the signature line for the IRA, and then you send that into CamoPlan, and we'll sign on behalf of the IRA's third-party administrator after we've processed it, which is again within 2 business days of receiving it in good order, and then we'll send the funds to the title company for the purchase based off the instructions that you put on the asset purchase directive. And then the promissory, if you're doing private lending, you'll have a promissory note, and then the lender will be the IRA, and the borrower will be whoever you lend to. On the promissory notes, you'll actually sign because that's more so an agreement between you and the borrower. But you'll still send that into CamoPlan with the asset purchase directive. And then private placements, they'll have a subscription agreement where you'll want the subscriber to be the IRA, not you personally. And then we'll sign on behalf of the IRA's third-party administrator when you send that in with the asset purchase directive. Who signs the paperwork? We just went over that. CamoPlan signs on all transactions for the IRA, provided it's been initialed by the client and sent in with the necessary supporting paperwork. CamoPlan will sign except for those one-off instances which within private lending, where again we view those as more so an agreement between the borrower and the lender. So you'll actually sign as a client if you're doing private lending. Everything else, CamoPlan will sign as third-party administrator on behalf of the IRA. A very common question I get is, can I use my IRA for the down payment of a property I want to own personally? The quick answer is no. So the IRA, you can partner with your IRA with your personal funds. However, whatever percentage the IRA owns of a property is the percentage of all expenses it's required to pay, including down payment, purchase price, utility bills, renovations, anything like that, and the percentage of all return it has to go back into the IRA. So if you wanted to partner with your IRA 50-50, your IRA could only pay 50% of the down payment, 50% of the purchase price, and 50% of all other expenses, and it's entitled to 50% of all the return from that property. Just because you own the property 50% personally doesn't mean you can stay in it at all. Regardless of the percentage the IRA owns and you own, if the IRA is involved at all, you still have to follow those prohibited transaction guidelines to their full extent. So you can't live in the property, you can't work in the property, as well as any of the disqualified persons or entities are prohibited from doing the same. Can my IRA receive a loan to purchase a property? It can. However, it can't be through your traditional loans. When the IRA is receiving a loan for or financing for a property it wants to purchase, it has to be through what's called a non-recourse loan. If you're not familiar with non-recourse loans, a non-recourse loan basically means because the loan is being made to you, you can't personally guarantee it. The loan is being made to the IRA, not to you. And then if for whatever reason the IRA defaults on a payment and can make a payment on that loan, the only recourse the lender has is usually to go after the property that it's secured to or whatever is in within the IRA that the loan is made to. They can't go into any of your other IRAs that came a plan. They can't go into any of your IRAs elsewhere. They can't go into your personal holdings. It's only within the account that the loan was made to. And then because of these factors, the terms for these notes tend to be a little bit higher. There's more money that you have to put into these loans in order for a lender to accept those terms. Now, if your IRA is to receive financing for a property you want to purchase, there are some rules we'll go over about UDFI that you'll want to take note of if that's a strategy you want to utilize. Can I manage the property my IRA owns? Management is kind of a vague term. You, as the account holder, can pick the tenants. You can pick the color of the paint on the wall. You just can't go in there with a paintbrush and paint the walls yourself. So you can manage it. You don't want to have physical receipt of any of the funds entitled to the IRA. So if you have a tenant, you want them to send the funds directly to Camaplan. You don't want to pick them up yourself. You want to send them directly to Camaplan. You can also have a property manager do all these things. However, if the property being managed by that property manager is an IRA-owned property, that property manager cannot be a disqualified person. That property manager must be paid by the IRA because it's providing a service to the IRA, as well as if they're collecting funds for the property, rental income, it has to be in a separate bank account. It cannot commingle any personal funds or other funds. It only can be funds entitled for the IRA. You can't make contributions to the account. You can't take distributions from that account. However, that account that's collecting income from that property that's owned by the IRA can be used to pay expenses for that property based off the percentage the IRA owns. And then generally people return profits from that account either quarterly or annually, depending on what agreement they have with the property manager. What do I do if/when there's a capital call is another question we have. If you have an investment that has installment payments, or if you're into a private placement that is called capital, there's usually an initial amount that you send for the private placement, and then they'll call capital over a period of time. If that's the case on the asset purchase directive, when you initially make the investment, it'll say how much is the total investment price or investment amount and how much is to be sent out of the account. The amount to be sent out of the account is the initial amount that needs to be sent for that investment. And then the total purchase price will be the total amount that will be sent throughout the entire duration of the investment. That way we send that initial amount. And then whenever you have called capital or an installment payment for an investment, you'll have access to an online portal after the account's been created. And then when that investment has been made, you'll be able to log in and see that investment as an asset inside of your online portal, which will allow you to make payment requests. In the event of a capital call or an installment payment, you'll log in, submit a payment request, and mark it as additional funding for an existing asset. You'll attach or upload a copy of the capital call, and then we'll process that usually within 1 business day and send the funds based off the instructions on that form you complete. Some considerations, tax considerations, and resources that we'll go over. Usually IRAs are tax sheltered accounts and they don't pay taxes. However, in some instances, IRAs can pay taxes. The two most popular, or the two methods I see, are UBIT or UBTI, unrelated business income tax, and UDFI, or unrelated debt financed income, which we talked about a little bit earlier with financing, and at the very beginning about the differences between 401ks and IRAs. So unrelated business income tax, or unrelated business taxable income, is usually triggered when the IRS thinks you're running a business out of your IRA. So what triggers that is if the IRA develops on undeveloped land. So if you purchase a property with your IRA and then you want to build if you purchase a plot of land with your IRA and then you want to build a property on that, then that would trigger the UBTI tax. Another thing that I've seen trigger the UBIT tax is flipping properties. Now, what the IRS's definition of a flip is, they'll never say. So some people say you can hold the property for a year and you'll be okay. Some people say if you only do so many flips a year, you'll be okay. Those people are not the IRS. But the IRS looks at flipping properties as inventory in and inventory out. And they'll trigger the UBIT tax on you. So it's very important that you consult with your tax professional to make sure whether or not you have to pay that tax if you think what you're doing is flipping properties. Now, the other tax is UDFI, or unrelated debt financed income. This is triggered whenever an IRA receives financing for investment they're looking to make. So if you're purchasing a property and you're getting a mortgage through a non-recourse loan, that will trigger UDFI. If UBTI or UDFI is ever triggered, you should consult with your tax professional. Your tax professional would file a Form 990T and send that into Camaplan for processing. We'd sign on behalf of the IRA and then release the funds to the IRS to pay those taxes. How much tax you'll have to pay, or what percentage you'll have to pay, we don't know. Again, we're not tax professionals. These are just some instances that we've seen these taxes be triggered. If you want to know exactly how much you have to pay for these taxes, definitely consult with your professionals, and they'll follow that form and send that in to us to pay those taxes. So a little bit of the information. This is where we pulled all of the information from this presentation, the different IRS publications, and the Form 990T and different private letter rulings and court cases. All are available in these different sources, including Camaplan.com or the IRS's website. It's just to prove that nothing we said we pulled out of thin air. If you have trouble sleeping at night, you can keep these by your bedside. But just again to prove that we're not making this stuff up. All of the information was pulled from these sources. If you have any questions, I'm more than happy to answer them. If you want to call the number below or email wmucker@camaplan.com. I always like talking to people, talking through different situations, answering any questions, and helping them through the process. So I'm more than happy to help. And if you attended this live, or if you're watching this later, I appreciate it. I appreciate you lending me your time, and feel free to contact me with any of your questions. Or if anybody in the audience now has any questions, I'm happy to take them.